This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. This program is Central Florida's longest-running radio program. Started all the way back in the 80s by my late father-in-law, Jack Nelson. Looking ahead this week, May 1st. Crazy. That's already May. Wow. But May 1st, which is this Wednesday, marks a very special occasion for Nelson Financial Planning, previously known as Nelson Investment Planning. Changed it over to Nelson Financial Planning here a few years back to reflect a little bit more of what we do, since we do so much more than investment planning. We've got a pretty big tax and planning and tax preparation service, just to name some of the other things that we do at the office. But our 35th year, May 1, 1984, was when Jack started the business. So we celebrate 35 years on this Wednesday. So that's pretty cool. That's a pretty cool milestone. 35 years. That's getting up there. And we're actually celebrating the day, and also another similar celebration a week later with our clients, because without our clients, well, you don't have a business that lasts 35 years. So as we do each and every year, we do a client appreciation event that's different from the other events that you hear us talk about on the program. We also do events on a quarterly basis that are meant to be more educational in nature, where we bring a speaker in from the industry to talk about maybe the economy or the latest tax changes, or what's going on from an investment perspective. And so you hear us talk about that from time to time. But these events in May, and we actually have two identical ones because we like to make sure that the numbers don't get too big for the event, because, my personal goal is to be able to go around and at least spend some time with everybody there. And obviously, if it's too many people, then that gets hard to do in an evening. So we do the same event twice, and we do it every May, but we rotate where we go. And so the event this year, we're actually going back. Haven't been back to the Orlando Museum of Art for a while, so we're going back there. So we'll do that on Wednesday, and then we'll do it a week later on May 8th. If you are a client, you should have gotten an envelope in the mail with an invitation, an RSVP card. If for some reason yours got lost, or you might have just thought it was the generic junk mail, because it does look a little different, not too late to call the office and RSVP for that event, because, that should be a lot of fun. And I know a lot of our clients and the staff and myself look forward to it as a fun evening with friends to have a fun evening and get to tour one of Central Florida's gems, if you will, the Orlando Museum of Art. Been around for a long time, but I think it's one of those ones that it's been around for so long that people sort of forget it's still there, and and it is, in fact. So we're looking forward to that. So big doings on this coming week, especially with Wednesday marking our 35th anniversary as a firm. So good stuff indeed. Now, okay, over the course of those 35 years, we've seen a lot of things come and go, and the reality is that a lot of the fundamentals of investing simply do not change. But what is surprising to me in today's world is just how much more garbage there is out there. And I'm not just talking about the universe of mutual funds. There's 10,000 mutual funds out there. Our screening process that we do that starts with first making sure that every fund that we use has at least a 20-year track record. You need a track record at least that long to see how things did back in 2008, because if you're sort of ignoring 2008 from your analysis, then you're kind of ignoring what can happen. So we like to look through all the full economic cycle, the good, the bad, the ugly, the indifferent. And so one of the things that we screen for is those longer-term track records, along with consistency of performance, along with a team-oriented approach, a lot of other things that come into the analysis. But in our minds, you winnow that list of 10,000 down to a select handful of funds that, in fact, have a track record of consistently beating the market. And yes, in fact, that can be done, despite what a lot of the folks on the passive side say. What's interesting about those passive folks, the index folks, the ETF folks, is that, of course, what they don't tell you is that 100% of all index funds do not beat the index. We'll say that again. 100% of all index funds do not beat the index. Why is that? Well, because they have an expense in them. So they're never going to beat the index. So it's fascinating that they say that there's not opportunities out there to, in fact, do better than the market. We believe, and we've got the numbers to back it up, that says you can, in fact, do that if you are screening appropriately. But what we have observed more than anything, setting aside the conversation about mutual funds and active versus passive, and that will be a debate that I'm sure will continue to rage on for decades more, just as it has over the course of the past few decades, is just the garbage that's out there. Okay, setting aside the mutual funds, but on this past week we had a conversation with an individual that we had not had a conversation with. And, so they were in the office for the first time, kind of going over what they had. And so that conversation actually gave me some fodder for a topic for this morning's radio program. But then as I'm driving in, I hear the ad, okay, where, well, if the market goes down 30%, don't you want a guarantee, blah, blah, blah. And I'll tell you, and I'm not going to spend time talking about the guarantees and the annuity side of things. It's fascinating that they never ever in any of these ads or on any of these radio programs that run, where they never actually say what it is that you're actually going to own. And the other thing that's fascinating is they never quite ever disclose how much the commission is on those products. Those are some of the highest commission products in the business. I always find it fascinating, and I ask the question when folks come in with those products: did they tell you how much they got paid? And they said, "Oh, well, they said that it would all be taken care of by the insurance company." And I said, "That, okay, is never true, because if you think that you're going to make an investment in an investment product and somehow it's magically going to be taken care of by somebody else, and the cost isn't going to be passed on to you." There's bridges in Brooklyn for that one, folks. And that's where the conversation starts to unfold when you start to look at those insurance products, those annuity products. Very, very high expenses, because that's the only way that the insurance company can ensure it's going to make money on the deal, because understand that the insurance company is not issuing out this fabulous annuity contract, okay, for your benefit. The insurance company has it rigged so that they are going to make a profit. That's how it works. They make a profit because once you unpack the expenses in those guarantees, then at the end of the day, number one, it's never really as much as you thought. And we did a show on that, looking at the specific numbers about a month or so ago, where the conclusion was it's basically a 2% rate of return. Even if you are getting that magical 6% guarantee, it actually is, in terms of real rates of return, about 2%. The costs of those products usually will be around 3.5%, sometimes pushing to 4% per year. That's pretty expensive. The other issue is the sheer lack of liquidity on those. Oh, well, you can get out 10%. And look, if your liquidity is limited in any way, shape, or form, you've really got to say, you know what, I'm not interested. Okay, because we see that time and time again. And nowhere is that issue with liquidity more than when it comes to these real estate limited partnership, these REITs that are out there. Saw a situation this past week, and I just, the entire portfolio that this individual brought into the office to show us was sitting all in REITs. First of all, not very diversified, number one, because that just means you own one sector of the market. But number two, the lack of liquidity on those products is just mind-boggling. When you have to wait to the each quarter and have to kind of jump in and say, okay, I'd like to redeem this thing, silly, ridiculous thing that I have, you've got to wait. So you can only do it every 3 months. And then when you do that, you have to wait and have your redemption request done proportionately with everybody else. So if everybody's asking for a redemption request, you're only going to get a little bit of it. You're never going to be able to get out from under it. And for someone that is approaching retirement, and these people were 3-4 years away, how is that going to work? It's a terrible, terrible option when you look at how that liquidity plays out. We'll talk more about this liquidity issue because I think it's a big one that people just kind of blow right through and don't really stop and think it all the way through. So we want to talk a little bit more about liquidity and what it means for your investments and why it's important. But we'll take a break first here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and we'll be back after these messages here on News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1. My name is Joel Garris, and you're listening to the program that is Central Florida's longest-running radio program. Our firm's celebrating our 35th anniversary this week here on May 1. Got a little congratulatory email from Frank. Thank you, Frank. We appreciate that. Shows you time in market, consistent investment, and solid guidance. You can have success. No gimmicks, just common sense investing. Man, thanks, Frank. That's like a commercial. That's good. We appreciate those kind those kind comments. And we do have, of course, open lines and open email. Email is joel@nelsonfinancialplanning.com. And then the phone numbers to call in and be a part of the program, 407-916-5400. Toll free, 1-866-916-5400. Those are the numbers to call in and be a part of the program. On the program today, we're talking about the importance of liquidity, a question that I don't think many investors really have a handle on, particularly when they get involved with some of the investment products that are out there. You've certainly heard us over the course of the past 30-odd years on this program talking about those issues as it relates to annuities and guaranteed income and those types of things. Today on the program, we're focusing a little bit about something different from that, and that is these real estate limited partnerships, these REITs, those types of things that when first described, it sounds like that they've got liquidity. Oh, you can just, every quarter, you've got the ability to go in and take some money off the table with these types of investments. The problem is that you, along with everybody else that wants to take money off the table, needs to get in line with these types of products. And then, to the extent that there's available cash, and by the way, there might really not be when you stop and think about it, because if this is a real estate investment, chances are most of the money is tied up in real estate, which is not particularly liquid. Consequently, you wind up getting in line with everybody else, and you only get a portion of your request back in your hands. So much for liquidity on that. And heaven forbid, if you actually want to do anything with the entire amount of your investment, because that's just going to take you the rest of your lifetime to actually get back out. And when you start to really look at these, and we don't talk a lot about these on the program, but at their very core, they have a lot of the same issues that we have over guaranteed annuities and in these annuities that will have you participate in the market but not really have any downside. Doesn't exactly how it works, but that's how they sell it. The reality is, though, that when you start to have those types of limitations on liquidity, it can really make it very difficult for you as an investor, particularly in retirement, where your needs for your money may very well vary during the course of your retirement. And so when you have those big surrender charges, those can be a pretty significant hit should you need actual access to your investments. And so certainly with an annuity, at least, you have the liquidity. I mean, you know, if you decide to surrender it, you're going to pay the surrender charge, but you're going to have all of that cash in hand, and you know, so you have to deal with the surrender cost, but at the end of the day, you still wind up with your money in hand. With these real estate partnerships that are not publicly traded, my goodness, that's not going to happen. I mean, it doesn't matter how much of a cost that you agree to pay, you're not going to get your full amount back, or whatever the value is, you're not going to get that back in a lump sum, because the product or the investment that you're investing in is, by its very nature, a highly illiquid investment. So it's so important. I mean, in this particular case we saw this past week, I mean, these people were 3-4 years away from retirement. Well, what are you going to do? Every quarter you're going to, raise your hand and say, oh, I'd like to get some of this investment out. And then, subject to the whims of the company that's running the REIT and how many other people have asked for money at the same time, you may or may not get what you're asking for? I mean, how ridiculous is that from a retirement income planning perspective? Those products are in fact on the spectrum of things for a retired individual. I would even go so far as to put them lower or worse than some of these annuity products out there, simply because you can't get. And in this particular case, you put the whole portfolio in that stuff. Holy mackerel! I mean, you talk about really making it hard to generate an income in retirement. That's pretty difficult. So beware of these. I know we don't talk a whole lot about them on the program, but these are right up there with annuities in terms of our negative view on them, and they may in fact be a worse alternative than the annuities that are floating around out there, because you can never get full liquidity on them, and being able to access your money freely, especially during retirement, is of the paramount importance, don't you think? Because the point of being retired is that you no longer have a regular paycheck coming in. So you need something to replace that regular paycheck, and that should be coming from your accumulated assets that you've earned and saved over the course of your working career. If you can't get access to them, how good is that plan going to work? And it's just unbelievable how these products wind up in investors' portfolios and investors' laps without any real description of how they work. So make sure as an investor that no matter what you're doing, whether it's an investment in these types of products or an annuity or it's just a mutual fund in general, any investment, make sure you ask the question about liquidity. And don't just accept these wave of the hand explanations that says, oh, well, you can get out 10%, or, oh, every quarter you have the ability to do a redemption. No, those are significant limitations that really restrict and bind your hands of being able to access your money. And in retirement, I don't think you want that. You shouldn't, because that's not going to work very well. Anyway, we will slide to the break. When we get back from the break, we want to talk about the importance of understanding what type of retirement account you are, in fact, putting money into. A lot of confusion on that. We saw an example of that just this past week. And so we want to talk a little bit about that and hopefully educate our listening audience as to some of the questions to ask when it comes time for that. And then, of course, if you've got a specific question for us, we've got open lines here in the radio studio this morning. The numbers to call in and be a part of the program, 407-916-5400. Toll free, 1-866-916-5400. Those are the numbers to call on in and be a part of the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Some quick comments on the market. GDP numbers coming out north of 3%, 3.2%. Market cresting to new highs on the S&P 500 and the NASDAQ this past week. So that's pretty cool. Dow is a little off of its peak, but who knew, right? I mean, not much more than 3 or 4 months ago, it seemed that all hope was lost, or at least that was the message that the media was what was sharing with everybody. I had a conversation this past week with somebody who had came into the office, and it's like, oh, I can't believe how much money I lost. And I said, well, wait a minute. Okay. Have you checked your account any time over the past, 3 or 4 months? And the answer was no. All I know is that I lost money. And I said, well, but let's take a look, because here's the reality. Much like your perspective is, so too is the message that you hear from the media. All negative, all bad, all down, and they certainly like to fan those flames when it goes in the negative direction. But lo and behold, when it goes in the positive direction, you don't hear hardly anything about it. So when we looked at the numbers, not just the decline in the fourth quarter, but the increase in the so far this year, the decline wasn't as bad, and the increase was much more. So be careful of that. The message from the media is to always scare you, and that bad news has a tendency to resonate, and you listen to it much more, and it sticks in your mind much more. That's the fear element of our human psyche, right? And that fear element is a very powerful, perhaps the most powerful tool in our minds. And ultimately, the folks in the media know that, and so that's what they fixate on. And so it's kind of easy to miss the fact that the market has been on quite a bit of an improvement since the beginning of the year, and is in fact overall hitting a record high. So that's good stuff indeed, and much more importantly than what the market, of course, is doing on any individual day, week, month, or year basis is the concept of being consistent and doing it over time. As the email from Frank points out, which we shared before the break, time in the market and consistent investment are the two key principles to succeed. But certainly some good data out of the economy over the course of this first quarter of the year. Growth above 3% is always a good thing. So that's what's cooking, or what's going on in the markets and the economy, at least for right now. The other thing that we see quite a bit of is still, and you would think after all of this information out on the internet and the like, that you would not run into this kind of confusion on a regular basis, but we continue to run into confusion on the types of retirement accounts that you can have. And the advice, and in this particular person's case, because they came into us this past week for the first time, the advice that they had gotten, even in the financial services industry, wasn't on point with what their actual situation is. And what it comes down to is that if you're setting up a retirement account for yourself, you've really got to make sure that whoever is setting that up for you has an understanding of exactly what the structure of your business is. In this particular case, this individual had an S corp and was generating out a W-2 for themselves. They describe themselves as self-employed, but when you actually look at their structure of their business and how they are reporting it, well, they're an employee and they work for a business. However, on hearing that, she had been set up into a SEP IRA, which is a self-employed person IRA. And that's fine based upon kind of how she thought, or what she thought, because she owns that business. And so she views herself as a self-employed individual. And in a lot of ways she is, but in the eyes of the IRS, that's certainly not the case. So setting up a SEP IRA was actually the completely wrong thing to do in her case, because by setting up the SEP IRA, you basically mean that you as the employer now are also going to be making some contributions on behalf of all of your other employees. And that was certainly not what she intended to do. So the point is that there are a lot of different retirement accounts out there beyond just the IRA versus the Roth, beyond the 401k versus the 403b. There's also things like SEP IRAs. There's simple IRAs. There's money purchase pension plans. I mean, there's all kinds of other options that are out there beyond those traditional sort of IRA or Roth or 401k type of options. And for those that are self-employed, and more Americans are self-employed in kind of the sense of the expression, the reality is that depending upon how you set up your corporate structure, you may not actually be self-employed in the eyes of the IRS. And this was a perfect example of someone that, while it was their business, they were the sole owner of their business, and it was a successful business. The reality is, though, that they were not self-employed in the IRS because they were, in fact, generating out for themselves a W-2 paycheck, which is a great technique if you are doing an S-Corp, because you do want to show some level of earned income, and that's the notion of a W-2. And so, like the overall corporate structure that they had set up in terms of trying to save taxes, but then they had gotten some inaccurate advice in terms of the type of account to set up, and had deposited $5,000 in a SEP IRA, when the reality is that the only tax savings that they would have would be in an IRA in that particular situation, and the SEP, in fact, it would generate out an obligation to match other employee contributions. So the point is, whenever you are setting up a retirement account, it is so important to make sure that your tax return is handy for however that is getting set up. Okay, and if the person that is setting up the account, can't figure out or won't give you that tax advice that's necessary at that moment in time, then I would suggest you don't bother to do business with that person. Because if they're not willing to give you an answer as to the type of retirement account that you need based upon your tax return, what's the point in doing business with that? Because you might get completely inaccurate information, which is exactly what we saw. So now you're having to unwind a lot of the transaction. And how much of a difference did it make for this particular person? Well, she owed $1,500 on her taxes. She had actually made the contribution. So she made it to a SEP, and at the end of the day, wouldn't have been able to take that as a tax deduction. Had she been able to take it as a tax deduction, well, she wouldn't have owed money. She'd actually wind up getting about a $100 refund. That's a pretty significant difference. The reality is she did what she was trying to do, but wound up getting in completely the wrong account. Folks, when you're setting up these accounts, when you're trying to set up retirement accounts, when you're trying to save money on your taxes, make absolutely certain that when you are doing that, you have a copy of your tax return handy so that you can make sure that what you're doing is actually going to work the way that you intend it to work. Same thing on the conversation of an IRA versus a Roth. Put money into an IRA thinking you're going to get a tax deduction on it, and because of other parameters like income, like a retirement plan at work, you're not allowed to do that. You're not going to get the tax deduction. In that case, you should have been doing the right. Anytime you're making those kinds of decisions involving a retirement account, you've got to have that tax return handy. And the individual that you're dealing with better be prepared to give you a firm answer and not stand behind some silly disclaimer that says, oh, be sure to consult your tax advisor for, because we don't know. Okay? Do not accept that as a cop-out. When you're making an investment, when you're opening up an account, the folks that you're dealing with better be willing to stand behind what the tax advice is as it relates to that account. No ifs, ands, or buts about it. Anyway, I digress. But we'll take a break. And then when we come back, we'll reset and shift gears. And we've got open lines, 407-916-5400. Toll free, 1-866-916-5400. Email always open at Joel@Nelson Financial Planning. You're listening to Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Well, I'll tell you what, we've certainly had our share of kind of interesting commercials on this program so far, haven't we? Okay. So there's a pill I can take that, you know, will make me limitless. Wow. And then what was one of the ones earlier? I love the real estate pitches, right? Buy my CD come to my seminar, and I'll give you a free watch and a free trinket and all that. And then if you spend $5,000 to figure out my program, you know, that's fantastic. To which I always respond, well, if you got that good ideas, why are you selling them for $5,000? Just keep them yourself, I guess. But I digress, folks. Those two ads are the classic get rich quick, cut the corner, and somehow you can get there. And I don't care, you know, whether it's investments or health or any of that stuff. It's time in on it. It's not finding some magic answer, some magic solution. As we celebrate our 35th anniversary this coming week as a financial planning firm, it's one thing is readily apparent, and that is it's about consistency. It's about doing good habits day in and day out. It's not, I'll find some way to get rich quick. I'll buy the CD or doesn't work that way. Doesn't work that way with your money. Doesn't work that way with your health. I mean, to stay healthy, what do you got to do? Eat better, work out more. I mean, that's the reality, right? I mean, that's nothing new. And yet, we as a society keep looking for get healthy quick, get rich quick schemes. Anyway, I digress. By the way, the suits, as Jack used to refer to them as, the suits at Clear Channel. Well, it's not Clear Channel. It's iHeartRadio. The suits at iHeartRadio love it when I do stuff like that during the course of the radio program. I'll hear about that one tomorrow. Okay, but oh well, it's my show. I get to do it. Anyway, off that digression, back to the more disturbing news, if you will. And this has to deal with too many people getting caught up in get rich quick and trying to do things cut corners and do things the easy way. And you know where that leads you? That leads you to not having any retirement savings, particularly if you look at this latest status. 45% of the 76 million baby boomers in the United States of America have no retirement savings. That's a staggering statistic. How is that possible? Because too many get too caught up in get rich quick. I'll do it later. I'm not going to do it now. Later. Quick. And that is completely the opposite of what it takes to be successful as an investor. Time in, the earlier you start, the better off you are, and being consistent on it. But boy, those are some pretty tough numbers, right? 45% of the 76 million baby boomers in the United States of America have no retirement savings. Get on it. It's as simple as $50 a month. And it doesn't matter how old you are, whether you're 65 or 25. The sooner you start, obviously, the better off you are. But at least starting to save some level of money along the way is a necessity in life so that you have some more later on down the road. If you're part of that 45% that has no retirement savings, at least start something now, and at least try and build up some type of a cash emergency savings account, maybe do something in a retirement account. It doesn't have to be much, okay? People think, oh, you've got to have a lot of money, and that is true. There's a huge trend in the financial services industry to exclude people. It's one of these things that, with all of these advancements with the internet and technology and information and all that, what we're seeing is a growing trend in the financial services industry to exclude people that don't have certain levels of assets. You hear the ads just like I do. If you've got more than 500,000, give us a call. If you've got more than $1 million, give us a call. Folks, that excludes a whole lot of folks that are just trying to get started and to find a strategy. And that's one of the biggest reasons why in our 35 years of existence, we've never had an account minimum, nor will we in the future, because it's so important to just do something. And that's the point that people miss, is just start by doing something. $25 a month, $50 a month, $100 a month, because over time, that's going to develop a good habit. If you start to do that on a consistent basis and you put the time in on it and you have the consistency on that investment, ultimately that's going to lead to a sizable amount of assets. There's a presentation piece that we have in the office that talks about the individual who starts at age 25 by simply doing $167 per month, and they do that for 10 years, and in fact, for some reason they stop. The reality is, though, that versus the person that waited 10 years to start that same amount of money, the person that started 10 years earlier has over $1 million more than what the person who waited 10 years to do that. And so you can see the power of compounding when you look at these numbers, and even a simple investment of $167 a month can turn into close to $2-3 million over a 40 or 50 year time period. So the sooner you start, the better you are. And the power of time and compounding is just so enormous. But it requires you to start. It requires you to start at any level. At any level. But that's what it's all about. So that you're not part of this 45% of the folks that are approaching retirement, the baby boomers that have absolutely nothing in retirement. There's a way to avoid that. And it requires you to just start now, start small, but be consistent and increase it over time as your pay goes up. Fundamental strategies that we've been talking about for the past 35 years, and dare say we'll be talking about those same strategies over the next 35 years. Hope you're with us during that time. For now, though, we got to wrap it up. We'll be back next week here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.